Previously on 10 Minutes with Griffin, we discussed how when you compare the effective estate tax rate to the savings in GST and income taxes that you can gain through inclusion of assets in the gross estate, that can create good tax outcomes where maybe the cost of the estate tax paid isn't as significant as you might have thought otherwise. So today we're going to look at some numerical examples of where we can use simple algebra to show us a break-even point, which may enforce the payment of estate tax, but with a subsequent GST or income tax savings. So we'll see at which break-even point does that no longer make sense. That can be important, for example, if you're drafting a trust with a formula general power of appointment, or if you're a trust protector with the power to create a formula general power of appointment. However, there's always a catch with this. The biggest one here is that since payment of estate tax is the ticket to entry, you must engage in proper liquidity planning if you're going to look at this type of planning strategy and drafting strategy. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. Today's episode 164, is titled Effective Estate, GST, and Income Tax Rates, Part 2. I'd suggest you go back to Part 1 if you want to look at the concept behind this, as today's discussion builds on some of that knowledge. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. And if you'd like a copy of these slides, please email me at griffin.bridgers@gmail.com. Now, as we all know, the estate tax rate, for all intents and purposes, is 40% when we write up the brackets, because the estate tax only applies when your tax base, which is your taxable estate and your adjusted taxable gifts, exceeds your applicable exclusion of $11.7 million. But when we take into account netting out deductions, but including the estate tax and including the applicable exclusion, the percent of the estate which represents estate tax that's actually paid is usually much smaller than 40%. That is our effective estate tax rate. And, as we discussed, there's a benefit to including assets in the taxable estate, especially right now with such a high estate tax exclusion. And that is that inclusion of those assets and maybe even payment of estate tax in the taxable estate could result in savings, for one, in the GST tax if there is a shift of transferor for maybe a GST non-exempt trust, and maybe a savings in income tax through the step-up in basis. Now, all that seems conceptual and confusing, which is true, but luckily we're going to look at some numbers behind this general theory and this general concept that really the effective estate tax rate also has to take into account your effective GST tax and your income tax that are indeed avoided. So what we're going to do today is we're going to look at this just from the GST tax side. We're going to look at a kind of perfect numerical example with a GST non-exempt trust, which, as a result of our client's death, the taxpayer, will be subject to a GST tax due to a taxable termination. We'll assume that our client was the last living non-skip person who was the beneficiary of that GST non-exempt trust. So to put some numbers to this, our client is deceased and has a $10 million taxable estate, and also has a general power of appointment over a $20 million GST non-exempt trust. But the general power of appointment was determined before our client's death and is limited by a formula to be determined by the trust protector. We're not going to get into the nuances of what the formula is. We're going to work in a theoretical world and examine what might be the better formula. Now, intuitively, it might seem that the unused GST tax exemption of the decedent, our client, would be the best measure here, but we also need to look to the unused estate tax exclusion of the decedent, because if that's less, we may be paying some seemingly unnecessary estate tax. But the question is it seemingly unnecessary when you compare the GST tax that's saved? We also have to look to maybe a better formula, one which looks to the break-even point at which the amount of estate tax paid equals the amount of GST tax avoided. Now, we're going to assume here that there has been no lifetime taxable gifts, so we can assume safely that our unused GST tax exemption is equal to the unused estate tax exclusion of our client. So we'll check off the first two formula approaches. So essentially, there's a 1.7 million of unused GST tax exemption and also unused estate tax exclusion to use up here. So of this $20 million GST non-exempt trust, if we were to give a general power of appointment over 1.7 million of that, that would avoid GST tax for that 1.7 million portion, and also would avoid estate tax for the 1.7 million that's included in the taxable estate. But of that GST non-exempt trust, we still have 18.3 million that's not subject to that general power of appointment, and thus will still be subject to the taxable termination at a rate of 40%. So our GST tax will be $7,320,000. So what we did is we still had some tax that seemed inevitable on the GST side, but we did avoid a GST tax of $680,000, which is 40% of that 1.7 million that was included in the gross estate through this formula general power of appointment. And we got that without having to pay any estate tax. Now, for a lot of people, that might be good enough. You might stop there. But let's ride up the tax brackets and kind of see what happens here. What optimal approach might we have at our disposal? So what could we do by applying more general power of appointment under this formula to the 20 million GST non-exempt trust, maybe to avoid a taxable termination over a greater portion? And that would result in a payment of estate tax, but with a trade-off of GST tax savings. So what we need here is a good algebraic formula where we can figure out our break-even point where the estate tax paid equals the GST tax saved. So we have to dust off our algebra hats from middle school or high school and solve for some unknown. In that case, or in this example, our unknown we're going to refer to and label as G. That's the amount of the GST non-exempt trust that's subject to estate tax through the formula general power of appointment. So we can simplify our formula down to, on the taxable estate side, $10 million of taxable estate plus G, and then minus our 11.7 million exclusion multiplied by a 40% rate. That has to equal 20 million minus G, our constant, multiplied times the same 40% GST tax rate. So solving for G, we come up, after simplifying with I skipped some steps on the calculation, but we essentially have G minus $1.7 million equals $20 million minus G. We can solve for G and come up with a G of $10,850,000. So what that means is we could give a general power of appointment over up to $10,850,000 of the GST non-exempt trust before the estate tax that we pay exceeds the GST tax that is saved. So essentially our break-even point here is 3.66 million in estate tax paid for 3.66 million of GST tax saved. So we get a little bit of a better outcome with this formula over just simply referring to the unused exclusion and exemption for the estate and GST tax respectively. Now, it's important to note that this can't be done post-mortem. We are looking at a post-mortem situation here, but this would have to be a formula that's predetermined in the document, maybe by the settlor, or maybe by the trust protector through the trust protector's powers under the document before our client dies. Now, we also need to note that this doesn't just have to be a general power of appointment. This could maybe be achieved through an exercise of a limited power of appointment to trigger the Delaware tax trap, which has the same results here. It still causes inclusion in the gross estate, but instead of just simply holding a general power of appointment, you have to actually exercise a limited power of appointment in a state that allows you to achieve this outcome. It's increasingly difficult to do this because you need a state where an exercise of a limited power of appointment resets the perpetuities periods. And in most states, that's hard to do without giving a donee a presently exercisable general power of appointment, and that might be an inefficient use of GST tax exemption. But that aside, you need to also note that you need enough liquidity in this type of planning to pay the estate tax, because you're intentionally paying estate tax as a ticket to entry for other savings. Now, the benefit is that you can use the step-up in basis to generate this liquidity free of estate tax. And when we look to the step-up in basis, we may also have additional income tax savings that we need to look into a little bit more. And that's the part that we're going to look at in the next installment of this series, part 3. But you also might need to look to life insurance, which may be a good idea within that GST non-exempt trust to begin with, as long as you can plan to avoid estate tax on the death benefit itself. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.